Crypto. Are you investing when you buy tokens? Or are you gambling? When people go to the casino, some people know they're gambling. Some people think they're investing. Some people think they're gambling against the casino. The casino's not gambling. The customers are gambling. Only invest what you're prepared to lose is a coping mechanism in crypto. Would you say the same thing about your 401k? Losing everything is not normal. He's right. With your 401k, you're buying usually mutual funds, which are usually mostly established blue chip companies, or at least weighted heavily towards them. Those companies are actual thriving or once thriving or soon to be thriving businesses. They own assets. They own intellectual property. They sell goods and services that are presumably in demand. Stocks are the equity in that business. They represent something. They're backed by the branding, the assets, the products, services, the patents, all of that. Even in a bankruptcy, there's something to pay out. Maybe as a common stockholder, you don't get much or anything at all, but someone gets paid out. As there's a fire sale, those assets get bought by somebody else who then turns them into part of their business. The manpower, valuable manpower, some of those people that were doing a good job despite the failing business, they go on to do even better things somewhere else in a better business model, maybe a competitor. They just got out-competed. It wasn't really there. Not every failed business is because of corruption, right? Very few. It's mostly just the nature of competition. Well, in crypto, where are the assets? The tokens are not assets. I'm sorry. If I snap my finger and mint 1 million tokens, those are not assets. They need to be backed by something, or they need to represent something to be called assets, in my opinion. With Bitcoin, it's the most secure network. There's value to that. There's only one Bitcoin. It's not a surprise that Bitcoin was the first spot ETF approved. It's not a surprise. Bitcoin's special. Ethereum is special. Ethereum, we talked last week about Ethereum's block space possibly being a commodity while the token is probably a security. It's because there's people find the Ethereum block space valuable. They're willing to pay money to get their transactions into a block. Scott's saying that when people put the disclaimer, and content creators sound so stupid, like, oh, not financial advice, you might lose all your money, it's volatile. You should never lose all your money in an investment. You shouldn't expect to. With crypto, why would you expect that? Well, we seem to have turned this into a spectator sport, a rite of passage, getting wrecked. Oh man, high five, I got wrecked too. What the hell are you happy about? Why are those founders allowed to go on to another project and do the same thing and run that same play from scratch? Again, until this changes, it will remain very niche. Yeah, I kind of agree. And I think that's why the top 2 liquid, most established assets are recognized as spot ETFs in the United States, and not like the Caitlyn Jenner token that just launched last week. Her token, it sounds like they have a plan and they put their reputation on the line. It's not ETH and it's not Bitcoin. Neither is the one that you bought on Solana the other day. Neither is the one that your favorite dev launched last year. And neither is the token that goes with and shares the name of your favorite protocol that launched 3 years ago. You should not expect to lose everything. It's not a good look. And investing or gambling, man, oh man, I could rail on this for hours. Tokens are not like stocks. I'm an investor because I hold a token. Wrong. I could have this argument all day. You own nothing with a token. Buying a layer 1 token or a protocol token does not make you an investor. You have agreement with the founders. Most of the time, the founders are unknown. Their teams are unknown. Maybe there's one front man who's gets out there on the Twitter space, and you could look up his LinkedIn. You don't know everybody. like you do in a traditional business where it's like registered with the SEC and there's a process for them to even issue the stock in the first place that might take years. Years? You know how long it takes to sell a stock? It takes years. There's a lot of paperwork involved. There's like lawyers and like laws and rules and protections that go into it. Your tokens are likely just governance or gas tokens. They are not equity shares. Keep in mind, ask a founder. Next time he's on a Twitter space, it's an AMA. And now we'll take your questions about our token that we're going to launch for our protocol where the UI is beautiful, everyone loves it. Ask them if buying the token gives them equity in the business that was set up to launch that protocol. See what they say. I asked that to Eric on Monday. It's in my interview. Stumped him for a second. He had to carefully word his answer. We're American. Got to be careful there. But ask them, is this an equity share? What do I own when I buy this token? With NFTs, we know what you own. Fungible tokens are a little different. You don't own shit. You own jack shit. If anything, you're subsidizing the development of these protocols. It's always in beta. It's never finished. Why the hell are you buying the token? You better have a good reason. You're not investing in most of these. Ask your founders if it's an investment. Hey man, I bought 1,000 of your token at the launch. I'm an investor. See what they say. You're not an investor. They won't go on record saying you're an investor. What do you own? What am I entitled to? Am I entitled to profits generated by this protocol? I am. How much profit did you make last quarter? Oh, you don't know? How are you not keeping track? What kind of business is this? Stocks are different. Stocks are different. The CEO can't just sell a whole bunch of stock at 2 o'clock in the morning and not tell anybody. Founding teams owe nothing to holders, sadly. I'm not saying that's a good thing. This is why there's little effort to disclose company finances, name individuals who get generous allocations of tokens or deliver on promises. Across crypto, whether it's ETH, Solana, Cosmos, Algorand, Cardano, whatever, 90% of these roadmaps will never be hit. Everyone still gets paid, don't they? Get paid up front. Snap your fingers. Here are the tokens. 25% to the team, 12% to this, 10% to this, 2% airdrop, and then there's a community strategic fund. And the governance tokens, they get used to determine how those community pools will get used. It's in the hands of the community now. Of course it is. You got paid already. You don't care most of the time. So just be careful is what I'm saying. And guess what? The teams don't get to pay themselves. They don't only get to pay themselves any amount they pretty much want. They get to set the APRs to whatever they want, so they know at what rate they can sell their rewards and their incentives and staking, whatever you want to call it, staking income. They know probably their break-even point. If the token is this price, they probably know how much they need to sell to cover their allocation. So if they never get to sell it because of an implosion or a hack or a rug pull, they're still good. I'm not saying this is malicious. This is completely acceptable in crypto. A lot of these are not real businesses. So I love these questions. And like I said, I'll leave you with this. Look at your portfolio. Let's say you have 10 tokens in your portfolio and you have 10 founders that you know their email address, their Discord handle, their Telegram handle, and all that. How many of those founders, how many of the team members, the devs, or the validators are buying the tokens? None? Are they not bullish on the token? Why did they issue it then? Right? That's one question. If they're selling the token every day and they're not buying any back, why would you buy it?